So, what do a investment bank professional traders do, right, on a daily basis, right? So, welcome to a very new episode for the video series Professional versus Retail, right? Where in this series, I'm going to show you what is the different approach, right, taken by the professionals that is responsible for generating billions of dollars of profits for the professionals. Okay. Now, on the last video, right, I have shown you that why retail guy love to follow professional traders, right? And they think that just by following professional traders, right, they can understand how a pro trades, and they can understand how to make money, right, like the pro. But here's the thing, right? In the professional world, right, to be categorized as a professional traders, right, you should really, of course, trade, right? Because most of the time, right, retail traders, they will always confuse professional traders with professional market makers, right? So on this video, right, I'm going to show you what exactly an investment bank trader did, right, and whether you should, right, as a retail guy, follow a investment bank professional traders, right? Because in a investment bank professional traders, right, what they did, right, on a day-to-day basis is very different from a hedge fund trader, right? And if you are following the wrong guy, right, you are basically learning a wrong approach, right? Because an investment bank guy, their approach and their goal, right, is very different from a hedge fund trader. Okay, so here is a very typical workflow, right? A very typical procedure, right, that a investment bank professional traders, right, they will do, right, on a daily basis, right? So a professional investment bank trader, right, 80% of their time, right, what they're doing, they are really doing market making, right? So 80% of their time they are doing market making, right? And 20% of the time, right, they are doing what we call as a risk positions, right? 10% of it is a negative selection portfolio, and another 10% of it is a positive selection portfolio, right? Which I will go through later, right? So 80% of the time, right, an investment bank trader, right, what they're doing is really just market making, right? Because investment bank itself, right, is actually a broker, right? Investment bank is actually a institutional broker, right? So their clients, right, investment bank, they are really dealing with hedge funds, pension funds, right, and mutual funds, right? They are dealing with institutional clients, right? So they are basically helping institutional clients, right, to put order, right, into the market, right, to basically make the market, right? This is what market making is like, right? So 80% of the time, right, an investment bank trader, right, what they will do is that they will receive a phone call, right, from hedge funds, and the hedge fund trader basically tell them, okay, how much I want to sell, how much I want to buy, right? What stock do I want to buy, right? For example, I want to buy 50,000 shares of Apple, right, at a certain price, right? And once the professional traders receive the call, right, they simply put in the number, right, into the algorithm, into the computer system, right, and the algorithm will automatically match the trade, right, for the hedge funds, right? So they are basically a broker, right? So yeah, it's like you as a retail guy, right, you open a retail broker, account, right? So whenever you want to buy something or whenever you want to sell something, right, you just call the broker, or no, not call the broker, right? You just go into the platform, right? You just hit buy or sell, right? And the broker will basically execute the trade for you. Okay, so this is what 80%, right, majority of the time, right, a investment bank trader will do, right? So 80% of the time, right, is that they're really sitting in front of the computer, right, and literally staring at the screen, right, just looking at the algorithm to do the work, right? And yes, usually, right, market makers, right, they will have multiple screen, right? They will have 4 to 5 screen, right, in front of them, right? And so that they can basically monitor, right, all of the trades and all of the algorithm that is running, so that they can provide liquidity to their clients, right? And this a trader, in front of multiple screen, right, this is a very, very popular and typical image, right, when people talk about trader, right? So 80% of the time, right, is very boring, right, just staring at the computer screen and basically putting orders, right, providing liquidity, right, to the to the hedge funds or to the pension funds, right? So this is what they did, right, 80% of the time, right? 20% of the time, right, they are basically taking a risk positions, right? It means that they simply trade against the hedge funds or simply trade against the pension funds so that they can provide the liquidity, right? So 10% of the time, right, they are doing something called a negative selection portfolio, right? A negative selection portfolio simply means that they need to open whatever positions that is coming in, right? So a very good example is that, right, a hedge fund manager, right, or a hedge fund trader, right, they just put an order, right, through the investment bank that they want to buy 100,000 shares of Google, for example, right? So at a certain price, right? So this order go through the investment bank, right? And the bank, right, and the trader, right, will basically open a short, right, on 500 on the positions, right, so that it can basically provide liquidity to the hedge funds, right? And it's called negative selection because that professional traders, right, that trader is opening a positions that he don't want, right? He's not selecting a positions, he's not selecting a company that he want to short, right? Just because he shorts the positions, right, so that he can provide liquidity to the hedge funds, right, so that the investment bank can charge a commissions on the trades, right? And most of the time, a negative selection portfolio, right, is going to lose money, right, because you are trading against some of the best trader in the industry, right? Some of the traders that's going to make millions of dollars, right? So you're basically trading against a bunch of financial elites, right? So majority of the time, right, the negative portfolio is going to lose money, right? So that's why they will need to open a positive selection portfolio, right? So they basically open another portfolio, right, to trade whatever stocks that the trader wants, right? So that the profits on the positive selection portfolio is able to cover the losses of the negative selection portfolio, right? So let's say if your negative portfolio, right, lost $1 million, right, just by providing liquidity to the hedge fund, then that professional traders, that investment bank trader, right, he will actually need to open several positions in the market, right, speculating, right, and trading in the market, right, on the positive portfolio, right, so that the profits on the positive portfolio is able to cover the losses in the negative portfolio, right? So in a nutshell, right, a investment bank professional traders, right, they are basically 80% of the time doing market making, right? Actually 90% of the time, right? Because including the negative selection portfolio, right? Because the purpose of the negative selection portfolio is really trying to provide liquidity, right, to the hedge fund, right, when there's not much liquidity in the market, right? So yeah, including the negative selection portfolio, right, 90% of the time, right, a investment bank trader, right, 90% of the time is really doing market making, right, is really matching orders, right, is really providing liquidity to the clients, right, so that they can charge a commissions on the hedge funds, right? And only 10% of the time, right, is they are doing a positive portfolio selection, right, or what we call as a prop trading, right? So the objective of the prop trading, right, the objective of the positive selection portfolio, right, is really to make money, to make money so that it cover the losses on the negative side, right? Because on the negative selection portfolio, you are basically trading against the hedge funds, and hedge fund traders, they are basically some of the best traders, some of the highly trained, right, financial elites, right? So it's very likely that the position in the negative selection portfolio is going to lose money, right? So the profits on the positive portfolio is going to cover the negative portfolio, right? So this is how a investment bank professional traders do, right? And it has nothing to do with you, right? It has nothing, the objective of the investment bank trader is not in line with you as a retail guy, because you as a retail guy, your objective is to make money with your own money, right? But an investment bank trader, what they're doing is really just matching orders, right? It's really just making sales for the bank, right? Because they are providing liquidity to the hedge funds, right? So the investment bank can charge a commissions on the positions, right? So they are basically like a salesman, right? Like a salesman that basically help to generate commission revenue for the investment bank, right? So it's really nothing, right? Their objective is not in line with you, right? Instead, as a retail guy, you should really learn from a hedge fund traders, right? Because the objective of the hedge fund traders, right, is in line with you, right? Which is using your own money to make money in trading, right? Which I'm going to cover it on the next video, right? So it's a very different thing, right? So make sure, right, if you want to learn from a professional traders, make sure you learn from a hedge fund traders, right? Unless, of course, you want to start your career, right? Build up your career, right, in the investment bank industry, then go on, right? If not, right, if your objective is to make money with your own money, then you should really follow hedge fund traders. Okay, so yeah, remember to subscribe and hit the bell, right? And also leave me your feedback in the comment sections. Okay, I'm gonna see you on the next video.